All right, with a lot of concerns about a possible government shutdown, are you surprised at all to see futures moving higher?
Not even a little bit. I've been through this with government shutdown talk so many times I've lost count. It is not a market factor at all, and it hasn't been the last dozen times it's happened.
All right, that's a pretty definitive answer right there. So, David, your word of the day today is dividend. Are you saying that investors should focus more on dividend-paying stocks?
Yes, and of course, we believe that permanently. We think that profiting from the profits of companies is a wonderful way to invest, to constantly be de-risking by getting paid for the risk you're taking along the way. But also it indicates better companies that have that kind of consistency, stability in their free cash flow. So we find dividend growth to be a wonderful risk-adjusted way to invest.
All right. I want to get to your pick as well. Your pick for us is Moelis. It's a financial. Give us the case for this, because I want to ask you a few questions about this pick.
Well, Moelis is a fascinating company because I don't know how many companies have no debt on the balance sheet. How many companies return all profits to shareholders? It's a pure services business with investment banking, M&A, and yet they have no debt. They can return all of that free cash flow to the investors. When we bought it, it was a $2 or $3 billion company. Now it's a $6 or $7 billion company, and we've only owned it a few years and doubled our money, but we think it has huge potential in front of it. They've been hiring a lot of new bankers, preparing for a next round of M&A. We think that this is just a wonderful company with very little balance sheet risk whatsoever.
All right, so you like the company, you like the fact that they're debt-free. I want to talk to you about some of their peers, some of the other companies that are in the same space. If you look at a Morgan Stanley, a JP Morgan, even a TD, they trade at a considerably lower multiple. So is this worth paying up for this company?
Well, you're not paying up because JP Morgan and Morgan Stanley, which are both names we own as well as great dividend growers, are commercial banks with massive balance sheets. I mean, in the case of JP Morgan, the largest balance sheet imaginable. So their multiple is lower because their asset management investment banking business has a higher multiple, but then the commercial banking business has the lowest multiple in the S&P 500. It's a pure net interest margin business. Moelis, you're not getting a commercial bank, you're not getting insurance, you're not getting capital markets, you're getting advisory. Pure sell side, buy side, M&A advisory. Very different type of business that requires and deserves a higher multiple. The return on equity is 45%. The return on equity for a Morgan Stanley, JP Morgan is really nice, but it's significantly lower.
All right, making a very strong case. I'm going to go back to your first answer about the government shutdown. Not worried about it at all. You said it has zero market impact. Is this possibly a bit different with the idea that we may not see the jobs report come out on Friday or potentially other economic reports? Wouldn't that rile the markets?
No, you could get a day or two of volatility here and there, but I don't even believe that will happen because the markets shrug this off constantly. It is such a bore to markets. Everybody knows how it's going to end. They're going to go back and forth. There'll be headlines. It has to be covered. I don't doubt that it's a political story, but it's not a market story. There is no sense in which this is going to fundamentally alter anything about the economy. And everybody knows the government's going to reopen, whether it's in 2 hours, 2 days. These little stunts just don't last. And this has gone on now for over 15 years, over and over again. Okay. At some point, markets learned their lesson, and so did I.